Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Enlightened investors, I'm sure that you, like me, are on the lookout for investments that lower the risk while at the same time maximize returns. I'm excited to be in conversation today with an investor who unlocked the formula for consistently doing just that. Today, we visit with Matt Ricciardella, who is the principal and managing partner of Crystal View Capital, a private equity real estate firm that specializes in the acquisition and management of self-storage facilities and manufactured housing communities across the United States. Matt, before we get into minimizing risk and maximizing returns, share a memorable experience from your formative years that helped you to be the person you are today.
Yeah. Hey, Alan. First off, thanks for having me. It's a pleasure being with you today. When I think of a memorable experience from formative years, first thing that comes to mind is the lessons of hard work. And grew up as a kid, and our family business at that time still is the restaurant business. And I started at the bottom, started washing dishes and waiting on tables and working my way up from the ground floor and, learned the value of a dollar and hard work, and never forgot that. So as years went on, as my personal wealth grew, you never forget where you come from. And you never forget, if you make a couple mistakes, you may end back up where you started from. So those lessons for me were invaluable, and, I'll never forget them.
Well, I've had some experience in the restaurant business as well. I was a restaurant owner myself for a time, and then a manager at a fast food restaurant. It is work, let me tell you, and it's a never-ending job.
It's a grind.
Yes, it is. So I know what you mean by learning to work hard. I also like what you said about the fact that you learned early on the importance of mistakes and how even small mistakes can set you back from where you began. Well, let's get into minimizing risk and maximizing profits and look at the importance of investing in real estate over the long term. So talk to us about how you do that.
Yeah, so I think the best way that we mitigate risk is when we take a look at an investment. As you mentioned earlier, Alan, we specialize in manufactured housing and self-storage, and I've been investing personally in those two asset classes for about 16, 17 years now. So over time, you gain what I like to call pattern recognition. You understand certain patterns and you understand where the pitfalls lie. So when you're entrenched in it, you really understand where your potential risks are going to fall. And I could go into the detail and the minutia, but really, I think the bottom line is understanding risk and getting comfortable with risk. Because in every single deal you do, whether that be a real estate deal or you're buying stocks or bonds, there's always an inherent risk. And any sponsor or promoter that says this is a risk-free investment and you're guaranteed to make money, I would run the other way. Because no matter what you do, there's always a risk. It might be small, but the risk is there. And our job as investors is, as you mentioned, is to mitigate that risk. And the way we do it is we have an investment committee within our company. And each deal that we look at, we sit down in our investment committee and our analyst puts together a financial model and projections and where we're buying the asset. Here's going to be the rent increases between year 1 to 5. Here's what we're going to do to expenses. And the team will kind of look at that deal and we'll have a robust discussion about what everybody likes or dislikes about that deal. And to get all of that out there on the table really helps us to understand what we're getting into, and we can make an intelligent decision. And if we get comfortable with the risk, we'll move forward with that deal. I'll give you an example. We bought a large property, and you said you were from Colorado. It was in Colorado Springs. It was about a 200,000 square foot distribution facility / self-storage facility. And we bought the property based upon the income that was being generated from the storage facility, but the distribution facility was completely vacant. So our risk on that deal was not being able to lease up that space. And we still got comfortable with the fact that this property is still going to perform reasonably well, even if we don't lease up the distribution space. Well, fast forward, we did lease up that space, and now it was a home run. But if we didn't, we wouldn't have lost money. So I think that's a good example of understanding risk. And if you could still, I like to say, flip a coin and it's heads you win big and tails you don't lose that much, then those are the type of deals we like to do.
Well, thank you for that example. That's an excellent example of how you actually mitigated that risk. Probably some less experienced people could have looked at that deal and gone into that and said overconfidently that we are going to lease up that distribution center and not have looked at the cash flow from that other aspect of that and gone into that and then not lease that up and been in a really tight financial situation, because I'm sure that distribution center made a big difference on the profit margins on that particular property.
It was huge.
Yeah. And I'm glad it worked out well for you, but you all mitigated the risk by knowing that you could handle that even if that didn't happen. And a single tenant occupied space like that, it's always a risk. I can see how if you didn't take that into consideration, you could be cutting yourself off at the knees there.
Sure.
Well, you have been investing in manufactured home and self-storage facilities, like you said, for the last 20 years or so. How did you get into that, and why did you elect to focus on that for the last 20 years?
Yeah, it's a good question. One I get a lot. When I started, I was green, like the rest of us, and I didn't know where I should put my focus and my attention. So I kind of surveyed the landscape and looked at all asset classes, all 4 food groups, that being multi-retail, industrial, and I kind of invested across the board. Office, retail, multifamily, and industrial. I bought each and every one of those 4 food groups, and I understood how to manage them. And I understood how to create value in each of those asset classes. And I found time and time again that these niche assets, which what we're talking about today, self-storage and manufactured housing, I was able to create the most value in those property types because of management inefficiencies. And by and large, they produced more free cash flow than all the other property types. And I just enjoyed working in them and understood them and learned the nuances. And it was when I first started, Alan, these 2 property types were kind of like the redheaded stepchild. When you'd go to a bank or an investor and show them your business plan and tell them you're going to buy a mobile home park and you have plans to increase the rents and make improvements to the property and fill vacant sites, they'd kind of look at you a little funny and say, "You sure? Is that's really what you do?" Well, fast forward now 20 years later, and everybody understands that these are cash cows if they're bought right and managed effectively. So, we raise capital quite easily because of our track record on one part. But the other part is investors want exposure to these property types because they're defensive in nature. They produce a very strong free cash flow, and they tend to do better, quite frankly, in down markets. So, and COVID has proven that, our properties have actually outperformed during COVID compared to prior to the pandemic. So very interesting, these property types. They've treated me very well, but that's kind of a glimpse into why I got involved and why I've stayed involved in these 2 property types.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145. or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. Correct me if I'm wrong here, but I understand that these 2 investment types also have a lower expense ratio than multifamilies generally do. Have you found that to be the case?
It certainly can be. I'll give you an example. We'll compare manufactured housing to traditional apartments, multifamily. A resident, you raise the rent on an apartment building on a particular unit That resident moves out, goes down the street looking for a cheaper rent. And as the landlord, you've got to go and turn that space over. So what does that mean? You've got to perhaps put in new carpet, new vanity, new tile, repaint that property. That could cost you, especially today with the cost of materials and the lack of contractors out there. That's a whole different discussion. But in a normal market, that could cost you $15,000 to $20,000. You lost a tenant. Now you're trying to gain a new one. So it's more capital intensive compared to a mobile home community. You raise your rents. And that tenant, bear in mind, owns that particular home. So you don't maintain the home. Roof leak, bathroom is not working properly, the carpet came up. That's going to be the tenant's responsibility. So your capital requirements are a lot less. And to go to the earlier scenario of turnover, for that resident to move that home from your community to one of your competitors is going to cost $6,000 to $8,000. So typically you have no turnover in these communities, and it's less CapEx, less operating expenses, which translates into higher free cash flow and the ability to create value easier, in my personal opinion. So that's why we like manufactured housing compared to multifamily.
Yeah, that makes sense. And it just sounds more and more attractive all the time. Well, what are the downside to mobile home parks and storage facilities in terms of an investment class?
Well, there's always going to be a downside. And I think that's a relative question because it's going to depend on each person is probably going to perceive that a bit differently. In my opinion, mobile home communities, the downside is the management. They're very management intensive. For me, that's not an issue because we have an infrastructure and a team in place, and we have all the management efficiencies to effectively create value and to manage that property effectively. But for a newcomer coming into the space, not knowing any of that, it could be a nightmare. So you just have to understand your risk tolerance, going back to what we discussed earlier. But are you equipped to manage that property type? Do you have a team in place? Are you comfortable outsourcing it to a third party, which in my opinion doesn't do as good of a job as an owner who cares about the property because their own capital is at stake? So I think the downside to manufactured housing is the management intensity. In storage, I think the downside is certain markets are oversupplied. So you got to really understand those markets. You know, for a long time, Denver was oversupplied, Portland was oversupplied, Nashville, Tennessee, Dallas. That's starting to change because of exodus from urban centers coming into these secondary and tertiary markets. But you got to really understand the market you're buying in, because if there is a lot of supply, a glut of supply in that market, you're going to have to offer concessions and price breaks in order to gain new tenants. So that, in my opinion, is the downside, the biggest downside to storage.
One other thing I'm wondering about, you mentioned the management issues in conjunction with particularly mobile home parks. In multifamily, there's really a slew of property managers, and you can interview 2 or 3 or 4, and you can probably come up with pretty competent management outsourced team. I'm wondering if the same is true in mobile home parks, or if there is a shortage really of competent third-party property managers in that realm.
You know, it's tough for me to answer that because the last time I worked with one was probably 17 years ago, and I've never done it since. So I'll let that answer your question. Not to say there's not a good manager out there. If there is, I don't know who they are. It is a very nuanced asset class. So it's not as though you could go in the yellow pages, buy a mobile home park in your backyard and find a manager that could manage it. You really need a more special optional firm that understands the asset and how it's managed and understands the laws in the area, has counsel that understands the laws. Because if you make one mistake on your lease and you're in certain markets like New York, like we are, that could cost you hundreds of thousands of dollars. So you really have to understand your leases. You have to understand the rules and regulations. You have to understand the eviction laws. There's a lot more that comes to it than just collecting the rent, although that is a big part of it. And a lot of these management companies don't do as good of a job as we do because we incentivize our on-site teams to collect rents. And they share in that on an incentive-based structure. So we like to say we create a platform where our managers think like owners. And that's our company culture, is a meritocracy, and think like an owner. And the way that you do that is you incentivize accordingly. And that's proved successful for us. And I don't see many third-party managers doing that. Why should they? Because they don't own the property. They're doing it for a fee. We're managing from an owner's perspective, and there's a very big difference.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios, selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Well, that has been my experience, even in standard multifamily, is the property managers just don't really have the same incentive that owners do. Can you give us some examples of how you are incentivizing your property managers to collect the rents?
Yeah. So, let's take a look at COVID. None of us knew what was going to happen, unprecedented times, as they say. And I didn't know who was going to pay and who wasn't going to pay. So we went to our on-site managers, and each property is different, mind you. Some of them, the delinquency percentage is less than 1%. Some of them, it's more than 10%. And it depends on the market, depends on the quality of the asset. But the manager plays a big part in that role. How aggressive are they willing to get? Will they knock on doors when a tenant's late? Will they continue to call them and work out a plan, have them come in? So during COVID, we really got aggressive in terms of the communication with our tenants. And the hounding, it's how can we help you? We're in this together. We don't want you to get behind. We don't want you to get evicted. Or on the storage side, we don't want you to lose your stuff. So what we would do is we typically tie it, Alan, to answer your question, we tie it to the delinquency percentage. So it's a sliding scale and it's different at each property. But if, as an example, if their delinquency is less than 8%, if it's at 15 now and they have to stretch to get down to 8, perhaps, we share $200-$300 with them. If they get down to 5%, it's $500. If they get below 2.5%, it could be as much as $700. And really, that extra income, it's well worth paying it from our perspective and our owner and our partner's perspective, because that extra income, when you apply a cap rate to it, translates into hundreds of thousands or even millions of dollars by just giving the on-site manager a couple hundred to an extra $1,000 a month. I would consider that a very good investment, and that's why we do it.
So is this incentive while they're getting to a particular percentage, or if they maintain that, do you continue providing that incentive?
We always make those incentives a moving target, because once they get it to that level and they get comfortable, that's when we go ahead and shake it up and start. So they're always striving to improve. Otherwise, they're just kind of sitting back and collecting the fruits of their labor from the past. We want them to continue to strive and continue to create value for the asset year in and year out.
So say they get to 1% delinquency there. Where are they going to go from there? That's a pretty good rate.
That's a pretty good rate, but there's more things to create value. On a scenario like that, we have given, a perpetual incentive to maintain that. But what we would do is say, okay, now you've got down to 1%, but you're 90% occupied. Now let's load up the incentives to get up to 95% occupancy, or let's load them up to get to 98% occupancy. You're not selling enough tenant insurance or U-Haul truck leasing. So now we'll tie the incentives there. There's always something you can do to create value. And we want their head focused on that area because it ties right back to their pocket.
That makes sense. The question I have here is, so they get to this 1% delinquency, and then the incentive changes. Is it perceived as a punishment?
I guess you could consider it or perceive it whatever you'd like. The way I would consider it is we pay a very fair base salary, and we constantly are partnering with our on-site team to strive for excellence and excellence in their day-to-day interaction with their residents and their tenants and their performance and their excellence as a person. So I certainly wouldn't perceive that as a punishment as long as we're finding new ways for them to improve, as I am, as I think anybody who's an achiever out there is finding new ways to improve each and every day. Because if we just rest on our laurels and sit back and coast, then maybe it's time to sell that property because we can't create value much longer than that. So I wouldn't perceive that as a punishment. I would perceive that as we're their biggest fan, and we're a cheerleader with pom-poms cheering them along, always trying to make them better, trying to make the property better, and trying to make ourselves along the way.
Enlightened investors will be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time. I'm sure you put all of that in place and are sure even going into that, what that incentive program is all about so that they understand that it's going to be a continuously moving target there and that it's tied to personal growth and development and it's not just a one-sided effort there.
Sure.
So I'm sure it's cased in all of that there. I'm sure you are finding your properties through all kinds of different mechanisms, but you like to focus up on off-market deals. So how do you source those deals? How is that different from going through brokers? And why is it that you try to emphasize the off-market sourcing?
Yeah, so great question. And yes, it is our favorite avenue to source new opportunities. In fact, we've got an in-house sales team, and that's all they focus on is finding off-market deal flow day in and day out. And we've built up a database of proprietary information through my past 20 years of experience and painstaking research putting together this database where we contact the owners that kind of fit our prime targets of a certain size within two asset classes. And the reason why we like it is, right now the asset classes are hot. Real estate's hot across the board right now, and that's no secret. So to go out there and compete with the rest of the players out there, the institutional capital, the REITs, the other private equity firms, you've got to be willing to pay up to get a deal. Whereas in our approach, we go directly to the source. And a lot of times we're putting deals together that don't have competitors competing to get involved in that type of deal. And I honestly, Alan, I think it's a win-win. And a lot of the sellers that we work with agree because we go to them, we're direct, we're straight up. We tell them the price we're going to pay. And we honor that price and they have certainty of execution to know that that deal is going to close. When you work with a lot of buyers that are out there, a lot of them are great. Some of them tie you up at a higher price. And I know because I'm a seller too. And you get to the end of your due diligence phase and they say, well, I know I told you I could pay $5 million, but I'm sorry, I can only pay you $4.5 million. And I just wasted 59 days of your time. Do you really want to start over? That's common, unfortunately, in our business. And we have a reputation for not doing that. And the sellers certainly appreciate that. And we don't disturb their residents. We don't disturb their employees. They know that deal is going to go through. And I think what we've done speaks volumes because a lot of our sellers actually subsequent to the transaction say, hey, you did what you said. I enjoyed working with you. I'd like to get involved in what you're doing as an investor. And they come in and they write a check. And a lot of our investors are former sellers. So I think that alone again, speaks volumes for how we transact and how we do business.
Well, reputation is important in endeavor, but it is, I think, triply important in the real estate industry because it really isn't that large a community, and word certainly does get out there and get out there pretty quickly.
It sure does.
Well, Matt, share with us how it is that we can get in touch with you.
Yeah, absolutely. If you have any interest in learning a little bit more about our company and seeing if it's a good fit for your investment needs, we could be reached at invest@crystalviewcapital.com, or feel free to visit our website at www.crystalviewcapital.com.
Let's go into our last segment here. And if you would share with us one of your most difficult setbacks, and how did you come through that time, and what did you learn from it?
Yeah, well, boy, that's a good question and a tough one at the same time. Probably from a business standpoint, I'm assuming is where you want that question to go versus personal. But from a business standpoint, my most difficult setback was back in 2010. I like to use the phrase style surfed. And that means I moved away from my core competency to try something new. And I bought actually a string of gas stations in Las Vegas. And that's the reason why I moved out to Las Vegas originally, and worked hard to turn them around, and bought the real estate, and subsequently sold the real estate and did quite well. But the business aspect of it, very, very challenging. And I had partners, and that relationship was fractured and difficult and not enjoyable, to say the least. So the lesson that I learned from that is stick to your core competency. If you know something and know it well, chances are you can make a lot of money in it, and just try to become better at it each and every day. And that's what I'm doing now. I'm sticking to my core competency, and I'm selecting my partners wisely. And that's proven quite well for me. And that was a good lesson learned.
Sounds like a great lesson learned. It is interesting, though, isn't it, how some of the greatest lessons that we learned are some of the most uncomfortable at the time. Yes, indeed. Yeah.
Yes, they are.
Well, imagine that you have come to the end of your life, and as you lay on your deathbed, what do you look back on as your greatest joy and sense of fulfillment?
Boy, you got some good questions, Alan. I think as I sit back, somebody said something once. They said, nobody lays on their deathbed and says, boy, I wish I would have spent more time at the office, right? I love to work. I love the satisfaction that accomplishment brings. But I think when I look back, the thing I want to be remembered for, or the thing I want to have a personal sense of fulfillment with, is that I made a difference in someone else's life. For me personally, to come from nothing and to have no formal education, if I could impress upon somebody like myself that has no contacts, no background, no pedigree, but to instill in them that if they believe in themselves and they work hard enough and they're committed, they too could have unbelievable success in this country. If I could get that across to a few people, I believe my life would be a success as well. That would be something that would be great.
Sounds like some great goals there. And I hope you have a long and fruitful life before that time comes here.
Me too.
Matt, it has been a pleasure. It has been very enlightening. And it is always a pleasure, of course, talking with people who have been well established in their investment careers. And you certainly have a solid foundation upon which to share with us. And I appreciate all the insights you shared with us. Wished we had a little bit more time, but try to keep this to a reasonable time to get back together someday and talk more about these things.
That would be nice.
Thanks for being on the show, Matt.
Thank you, Alan. I appreciate your time. Thanks for having me.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.